The housing market in the early 2000s was a perfect home buyer's market. Mortgage interest rates were low and property value was rising fast with no signs of slowing. This was seen as a perfect time for people to get a loan. Property was considered to be great collateral by the banks, and banks would make mortgage deals even if they thought the buyer could not pay back the loan. If the buyer defaulted on the loan, the bank would get a property asset which had increasing value. These loans are known as subprime mortgage loans. They're usually given to people with bad credit, no credit history, or a history of later mispayments. These loans usually have high interest rates to compensate for the risk the bank was taking. They often had initial low interest rates to lure the buyer into the loan, but in reality, the rate was subject to increase after a certain amount of time. Rates such as these give buyers no cushion for events such as job loss or changes in the market. On the other hand, whereas prime mortgages are well-structured mortgages, given to people with good credit history, and no history of later mispayments. People who had well-structured mortgages wanted to access the equity in their homes, but it was locked into the increasing value of the property. For example, if a buyer bought an $800,000 home and took out a $400,000 loan, and the value of the house rose to $1.6 million, the equity was then $1.2 million, but the owner could not access this cash. To gain access to the $1.2 million or the equity in the home, owners went back to the bank and either refinanced or took out a second mortgage. They then were stuck with a higher mortgage, which was at a higher interest rate, which now made the prime mortgage holders now subprime mortgage holders. With the number of prime mortgage holders switching to subprime mortgage holders, and with the increase in original subprime mortgage holders because of the easiness to get a loan from the bank, the housing market began to fall into a danger zone if the market would have changed, but no one ever thought it would.
Ce serait mentir de dire tu ne me manques pas. Ce serait mentir de dire ça ne me touche pas. Qu'aujourd'hui tu vas t'unir.
The problem got worse when market players around the world, such as Lehman Brothers with lots of money to invest, began to invest in high-risk mortgage bundles, also called mortgage-backed securities, that were sold by the banks. The banks combined prime and subprime mortgages into one bundle and sold them to investors who did not understand the risk associated with the purchase. The banks did not care about the quality of the bundles because their responsibility was gone as soon as the sale was made with the investor. Most of the bundles were of bad quality.
Ça aurait dû être moi, personne d'autre une belle robe blanche, je n'ai pas cette chance. Oh, qu'elle était là, toujours était là pour veiller, veiller. Oh, qu'elle était tout près, on s'avoue qu'elle vivait, qu'elle veillait.
The crisis came along, and property values stopped rising, and many subprime mortgage holders began to default on their mortgages. This would have been okay in a good market, but when prices fell, banks started to foreclose on houses that were rapidly losing value. With more defaults, banks began to lose money on their foreclosures, causing a chain reaction, which caused investors to lose money on the previous purchased mortgage bundles. This eventually created a stall in cash flow and contributed to the recession and the housing market crisis.
Chineke me, I'm with you, my love. A planet, yodi, hey, rocket, I'm with you, my love. With you, everything is well, your love, they make my heart to do yodi.